Hello. Today we're going to talk about credit sales in Chapter 5 and other accounts that go along with credit sales that show up in the financial statements. We have seen some credit sales already when we were doing journal entries, but credit sales are known as sales on account or services on account. What that means is the company has provided the service or the product to the customer, but the customer has not yet paid the company. Now, this is very common in business transactions, especially when the customers are also businesses. So many businesses will give the customer 30 days to pay or whatever, and we'll get into that a little more later. Okay, so this is really common for business transactions, not always so much with consumer transactions. All right, when we record credit sales or credit service, we instead of receiving cash at the time of the sale or the service rendered, we have accounts receivable. Okay, accounts receivable is an asset, it goes up. Service revenue is a revenue account, it goes up with a credit. Okay, other types of receivables, we have non-trade receivables and notes receivables, which are also covered in the chapter. All right, trade discounts are nothing more than a volume discount, and we don't do anything special in the books for those things. We just record the sale at whatever the discounted price is. All right, sales returns and allowances. This gets a little more involved and something that I think we need to spend a little more time on. If the customer is not satisfied with the product or service, it's the wrong size, the wrong color, didn't work, whatever, the customer can return the product or the company can give them an allowance for it. Okay, these are both treated the same on the financial statements, but they are separate accounts. These are expense accounts that reduce the amount of revenue from gross revenue amounts to net revenues. Okay, a sales return happens when the customer actually returns the product. So they got it and it was the wrong size. They send it back. What does the company do when they get it back? Well, if the customer purchased it in cash, the company will issue them cash back for it. If the customer had purchased it on accounts receivable, then the company will reduce the accounts receivable balance, how much the customer owes them for the amount of the merchandise that was returned. Okay, sales allowances. This is when there's something wrong with the product or it's the wrong thing or whatever, and the company says don't send it back. Okay, so if it is, something that they're not going to be able to sell again, or if the shipping to return it is going to be more than the product is worth. Okay, I've had this happen to me on Amazon where I've processed a return and they say, here's your credit, don't bother sending it back. Okay, this is a sales allowance. Okay, the same thing happens if they have a sales allowance in the books as if they actually return the product. Okay, the seller issues a cash refund if it was originally a cash sale. They reduce the amount of accounts receivable if it was on account. Okay, when we record a sales return or allowance, we're going to debit sales returns or sales allowance. Again, it is an expense account, so it goes up with a debit, and we reduce the accounts receivable if the original sale was on account. And since this chapter is all about credit sales, that's what we're going to focus on here. Okay, again, sales allowances, same transaction, just different name of the account. Sales allowances is an expense account, goes up with a debit. Accounts receivable goes down with a credit. Okay? Sales discounts. Now, these are different than trade discounts. A trade discount is just like a volume discount where the amount of the sale is decreased for the customer. Okay? A sales discount is an amount that the company allows the customer to deduct from the amount that they owe on accounts receivable if they pay it within a short period of time. Okay? As I said, with most business transactions, a lot of companies will give the customer, another business, 30 days to pay the balance. Now, some companies will offer discounts, sales discounts or sales terms, okay? And the terms there are 2/10, N/30. That reads 210 net 30. What that means is if the customer pays within 10 days, that's the /10, they can take a 2% discount. Otherwise, the net, the amount that was originally owed, is due in 30 days. So if the customer pays within 10 days, they can take a discount of 2%. Sales discount on the seller's books, on the company's books, is also an expense. Okay, so it's treated the same way as sales returns and sales allowances. Okay, the company receives the cash, the 98% after the 2% is deducted. The 2% is a sales discount, and the accounts receivable goes down by the whole amount. Now, the way to keep this straight is the accounts receivable was $2,000. When the customer pays, even though they're paying less than $2,000, the accounts receivable is taken care of. Okay, the customer does not owe that anymore. So we need to deduct the whole $2,000 from accounts receivable. But the company only receives $1,960 because they've taken the 2% discount. That 2% discount is the difference between the cash that they receive and what the original receivable was. Okay, the sales discount is a contra revenue account, and we'll see that in the statements in a minute. Okay, that goes on the income statement. All right, here is an example of an income statement, and this one shows service revenue. And earlier in the slides, there was a trade discount, and as you see, they've already taken the trade discount and only shown the net amount. Okay, they also have sales revenue. Then we have sales returns, again, negative amount, sales allowance, negative amount, sales discount, negative amount, net revenue, $1,960. Okay, so that is the net amount that is owed. This is an income statement that would work for if the transactions that we had here were the only transactions. All right, thank you.